Remember everybody talking about marry the home, date the rate? Well, here we are, trouble in paradise. We've seen that 6-month thing go by. By the way, the 6-month thing is just so your lender gets paid. It's not actually a requirement. However, it's been 6 months. Now you're able to refinance. Now what? Now are the interest rates where they should be? Now are you able to save money? We'll talk about all that and more on Living in the Denver Suburbs next. What's up, guys? Jeremy Kane, Living in the Denver Suburbs, eXp Realty. Thank you so much for tuning in. Today, I am ready to talk about marry the home, date the rate, and this is something that I've been waiting for. I knew that we may see something happen or a little kink in the steps, so I'm excited to talk about that. But first, please like, comment, subscribe, share this with anybody who may have purchased a home or is thinking about getting in the market. We're going to talk about all of that and more as we dive into this. So first things first, let's talk about, getting in the home for those people that bought a home, say maybe late last fall into the winter or, this spring, and they were kind of under the guise of marry the home, date the rate, meaning that you found the perfect home, you're going to pay a little extra for the time being. And once those interest rates came down, like everybody said, Q2, Q3 of 2023, well, we're here. And have the rates come down enough? Well, let's talk about it. A couple things need to happen for that refinance to come together. First thing is your home has to at least stay stable in value, if not appreciate. It does cost money to refinance, even though they're giving away free credits and waiving their origination fee. There's still charges that go along with the refinance. And so when that happens, you have to have equity in your home, because typically they just use that equity because no one's showing up to the refinance table with a $5,000 check. Sometimes you may, if your value stayed stagnant and you could come up with $5,000 and you got a way better rate, absolutely. So home values did what they needed to do, at least hang tight. Since December, our average home price in the Denver market has been creeping up slowly, which is good, at a much better rate than the crazy 20% per year rates we were seeing of appreciation. And so that's a check. That's probably okay. That goes along with the idea, marry the home, date the rate. Next thing we have to talk about is the rates. The rates have to improve, right? Because you're not just going to pay for a refinance just because they told you to. So the rates have to improve, which would bring your monthly payment down. Now, probably 0.5 point to 0.75 point would be, the minimum. So it makes sense for you to refinance. If it comes down lower than that, absolutely. That's, what a lot of people did when we were in the 2s and the 3s. Everyone was like, okay, well, I'm going to refinance. I'm going to pull cash out. I'm going to do this. And they got those rates so low, which is causing that interest rate gridlock, which is a whole nother topic about our inventory. So that's that piece of it. So the rates, have they come down? Depending on your situation, I'm hearing rates in the high 6s into the 7s even right now. And so, I'm no mortgage lender, but unless you were at 7.5 or 8, it's probably not even in that realm. So that's a big fat X there. And so the next thing I want to talk about is taxes. Colorado voters voted to repeal the Gallagher Amendment, giving the counties a little more flexibility in raising your valuation, getting it closer to that market value. Proposed actual value is what they say. And if you've been paying attention to the channel, I've had 2 specific episodes that you can check out. I'll post them right here and you can check them out. But that is why there's been such a big increase, because that limit is no longer on there. So there were, as the market increases and as your home has appreciated, which it absolutely has over the last 3 years, no doubt, then, those valuations are coming, and they're coming as kind of a shock, because not only are they going up like they normally would, at the maximum, they also don't have that limit anymore, so they're pushing further. So that's going to cost homeowners $200 to $300 right there a month in most cases at the mid to low end of the price range spectrum. So just expect that, understand that that's coming, and even if you do contest your value and say they lower it a little bit, that's going to save $20, $30, $40 a month. However, we might see, numbers. I've seen numbers as high as 500 as people are calculating. So that's something that's also going to come into play. And if you refinance, these numbers are going to matter especially if you're up against that debt to income ceiling. No correlation to what I'm going to talk about next. However, that debt to income is important. So that's pushing. So if you refinance, you save $150 because you lower your interest rate. Well, here comes January next year, the escrows will adjust, and all of a sudden you're paying $250 more for your taxes, and now your payment just went up $100. What's good, you took $150 off, but understand that that's coming. And so, if you wait until the interest rates come down, maybe where, the experts say they might go at some point, I don't even know when that will be at this point. If you wait for that, then we're going to be in trouble. So the next thing that, we had kind of in the similar time frame is that big hailstorm. It affected, 15 to 20 areas around the Denver metro area and over the course of 2 days. And what's that bring? That brings an influx of insurance claims. Well, the other part of your escrow account is your property insurance. And when there's more claims, your premiums go up. And so that'll also be coming into play probably right about the same time when those increased taxes come into play, depending on when you renew your policy. But this is something that's really going to affect your payment as well. And now, that $150 you were going to save on your interest rate, first of all, that's completely gone. And second of all, now you have these higher payments. And so you may not even qualify since your home hasn't appreciated at the skyrocketing value. If you put 5% down and, you were at your max DTI, well, now you might even qualify for a 95% loan to value refinance. And then we have all kinds of problems. So what's that mean? That's also a big X towards that, and probably not having the ability to refinance in that quick 6-month turnaround like the lenders and the realtors were taking to social media and promising you. So just know that, understand it's going to be okay, but we may see some cost of living increases, so to speak, in our mortgages coming here at the start of next year. So next thing I want to talk about is that debt ceiling, because obviously the interest rates have to lower, and we're in Q2, Q3, and now we're not seeing them lower. In fact, we're seeing them trend upward. And I'm no mortgage lender. You can talk to lenders. I'll talk in generalities here, but this debt ceiling crisis that we have, probably another government shutdown on the way. Does anyone know what happens when the government shuts down? Well, just some auxiliary, benefits. USDA loans are hard. Some parts of FHA are hard. And so you can't get the HOA, auto confirm or whatever they call that. And so there's a couple things, and it's not really, that it doesn't affect your day to day as much as, they act like it is, but it's a big deal when the government shuts down. Well, if this debt ceiling that we've reached at this point in January, now we're in June, not sure why we waited till now to talk about it. But they have some options here, right? Option one is just to raise the debt ceiling, probably the least tumultuous of the options. However, someone has to scratch their head, if we keep raising this debt ceiling, eventually it's going to all come crumbling down. What are we going to do? That'll probably have the least negative effect on the mortgage interest rates, and that's probably what's going to happen. However, that's not going to send, everyone's not going to jump for joy, and, markets are going to celebrate and everything's going to go, happy-go-lucky. That'll probably have a negative effect on interest rates, meaning they will probably, tick up a bit there. It just might not be for as long. The next option I heard today was a crazy platinum coin. I guess there's some clause that says you can mint coins and they can make it worth $1 trillion, and they can, take that to the bank and then pay the bonds and pay their investors that are due. And I'm no genius, but I think that would probably make a pretty big dent in our progress and inflation if we're just creating $1 trillion coin and using that to pay our debtors back. I don't think that's going to fly very well. I think that might have some fallout that we don't even want to talk about. Next, they could also do something like enact the 14th Amendment and change some things around, kind of pull a rabbit out of a hat, kind of kick the can down the road. And that could be an option. Hopefully it doesn't come to that. And then the fourth option would be default on the bonds. And that would be absolutely the worst thing, I think, for the market. Who knows what the economy would do there? That would be a pretty serious recession, something that they haven't really predicted. The experts haven't really talked about a major recession, and that could do that because all of a sudden now the confidence in the 10-year treasury, which is kind of our economic EKG, so to speak, where, kind of all markets kind of follow in line with that, whether, they stay within 2 or 3 or whatever points of that. If we default on those loans and now the investors are calling their bonds due and there's no money to pay them back, and default's never good. And so that would probably have a serious, increase in our mortgage rates. I've heard that no matter what happens here, we could touch the 8s. I've heard, somebody on MSNBC, talk about 8.5% interest rates. And I'm here to tell you that if that happens, it's okay. To date the rate, you're going to be dating your rate for a lot longer. You might want to consider marrying that rate at that point in time. But what's that mean for our market? Well, it's definitely going to pull back demand, which we don't have the inventory to supply, a quarter of the demand we have right now. So that might not be, the worst thing for the supply demand market. However, it's also going to further lock people into their homes as far as interest rate lock. And so our inventory is going to continue to struggle. And so we will still see, less inventory, maybe less demand, less transactions. The economy could struggle because, job loss and things like that. People can't buy homes when they lose their job. But the bottom line with all of this is definitely lock into that mortgage rate and take a second, in these, 8% interest times or whatever we get to really understand, okay, I might have to be in this, monthly payment for 5-10 years until I have an opportunity to refinance. It's not just a silly slogan. I might have to lock it in and really make sure. And then on the heels of those insurance and tax increases, at least in the Colorado market, you're really going to have to, make some sacrifices and, pay for your home more. Here's the deal. Like, all of these things are going to trickle right down into the renting world. If you're renting, you're paying 100% interest, so you're only getting a 92% discount if we get to 8%. But it is still an opportunity to buy. Who's that opportunity for? Again, those first-time home buyers, those people getting in. Investors are less likely to, scoop up all the houses. And so you will still have an opportunity, and getting in is the most important piece. But when you get in, make sure that you're committed to 30 years of that payment. And obviously things happen, but it's not as simple as marry the home, date the rate, like a lot of real estate agents and lenders have been blasting over the internet. So that's all I got for you tonight. Keep an eye on that debt ceiling. That's going to be something that's really going to impact, our interest rates at least, and probably our market at some point. So with that said, if you're looking to purchase a home and you're ready to roll, now might be a time to get in before we do have to pay those higher interest rates. At the end of the day, the market adjusts, people get used to that. That's just part of the deal. The prices level off a little bit, so you're not paying bidding wars and you're not, upping the price there and upping the interest. But that's where we're at right now. I just wanted to make sure everybody knew that. Like, comment, subscribe. I look forward to talking to you soon. If you have any questions, book a call on the calendar link. I would love to talk to you about all this crazy stuff I just, spit at you. But I hope you have a great day, and we'll talk to you soon. Bye-bye.